There is a pattern in the real estate market that brought down entire cities in the 2000s, always in the same sequence. In 2006, Las Vegas was riding the peak, prices soaring, easy credit, construction everywhere. A few years later, the implosion came. In 2008, it was Phoenix's turn, with the boom turning into an oversupply and falling prices. In 2011, San Diego was still feeling the rock bottom after the Great Recession. 7 stages, repeated like a script, from accelerated appreciation to excess inventory, from cooling sales to selective price pullbacks, to financial stress and the liquidation that prepares the recovery. And now, in 2025, the question is direct. What stage of the real estate collapse is Florida in? Let's find out in this video. First, subscribe to Keynomics and activate notifications so you don't miss the next episodes. Today, we will reveal each step of this pattern, remember the years these cities fell, and understand why, even after the collapse, they also rose again. Could this also happen in Florida? There are cycles that don't ask for permission. They form in silence, deep in the economy, by accumulation. There is no explosion. There is a crack. And the curious thing is that the signs always appear beforehand. They just aren't taken seriously while the money is easy. In the beginning, optimism seems logical. The streets fill with new developments, employment grows, credit flows. Everything seems to confirm the idea that this time is different. But history always returns to demand coherence. Prices start to outrun income, rents can no longer keep up, and the costs of maintaining a home, interest, insurance, taxes, HOA fees, rise in silence. When the bill comes due, no one understands why. And that's when the market remembers its oldest law. Everything that goes up too fast charges a high price on the descent. No cycle is random. It is the result of behavior that repeats, generation after generation. 1. Accelerated appreciation. It all starts with euphoria. It's the time when optimism is confused with growth. Prices rise faster than income and rent. Spreadsheets accept what, in normal times, would be ruthlessly revised. Credit is abundant, and each new contract reinforces the illusion of stability. The neighbor buys and profits. The agent sells in a day. The investor flips it before closing. And when everyone seems to be winning, the sense of risk evaporates. No one asks if the price makes sense. The market becomes a mirror, reflecting only its own euphoria. This is the phase where money moves more based on emotion than logic. What was expensive yesterday is cheap in perspective today. The narrative replaces prudence, and the market begins to believe in itself. 2. Loss of affordability. The second phase is more subtle. No one immediately notices that the cycle has turned. The mortgage payment grows, insurance becomes more expensive, the HOA fee weighs heavily, and the total cost slowly begins to suffocate. The dream remains, but the wallet starts to scream. Salaries no longer keep up. Disposable income decreases, and what once seemed sustainable now becomes a struggle. The buyer hesitates, the investor waits, the builder insists. This is the most dangerous transition, the moment when the numbers don't yet tell the full story. But human behavior has already changed. Families postpone decisions. Developers maintain their pace. And the market enters a gray area between optimism and denial. 3. Swelling of supply. While demand decelerates, the projects from the peak hit the market. Entire buildings are delivered, new neighborhoods appear on the map, and the inventory starts to weigh down. The excess isn't visible overnight. It accumulates like water in a dam. For sale, signs multiply. The time it takes to sell increases. Agents start competing for buyers, no longer for properties. Holding the asset becomes expensive. Interest, HOA, taxes, maintenance. Investors start selling to free up cash. And the builders, who once celebrated every delivery, now try to negotiate transfers and discounts. This is where the cycle begins to show itself fully. The peak of construction coincides with the beginning of the downturn. 4. Cooling of sales. The pace slows down. The showrooms empty out. Viewings decrease. Buyers have time again. What sold in a week now takes a month. And the prices no longer cause a line. They cause silence. Agents begin to adjust their narrative. It's not a crisis, it's a natural adjustment. But every discounted offer received reveals a new reality. Concessions are back on the table. Closing credits, repairs, bonuses. The urgency switches sides. The buyer waits, the seller hurries. This is the friction phase. The market hasn't fallen yet, but it has lost momentum. And in economics, losing momentum is the same as starting to fall slowly. 5. Selective price drop. The fall is never uniform. It starts where the structure is most fragile. Condominiums with high recurring costs, saturated neighborhoods, standardized properties, and leveraged investors. Reference values cease to be what is desired and become what closes. Old comparables become a mirage, and each new closing below the last one creates a new anchor, a new normal, on the downside. This phase separates those who understand the cycle from those who fear it. While some try to defend the price, others seek liquidity. The market enters correction mode. What was an asset of pride becomes an asset for negotiation. 6. Financial stress. Here the collapse is no longer theoretical. Delinquency grows, foreclosures multiply, and property auctions return to fill the weekends. The same newspaper that talked about a rush for houses now reports record repossessions. Indebted companies suffer. Banks tighten credit. And investors who bought at the peak discover the real cost of leverage. But it is in this scenario that patient capital returns. The cold money, which doesn't buy euphoria, it buys discounts. Funds begin to map out opportunities, analyzing where the price has crossed the line between value and desperation. Liquidity is no longer abundant, but the market begins to purify itself. The excess is removed, and what remains are assets with true fundamentals. 7. Liquidation and stabilization. Liquidation is the last stage, and the most necessary. Prices adjust, narratives fall silent, and the market returns to negotiating what exists. The bottom isn't a moment, it's a process. It forms gradually, as pain turns into rationality. The bad news still circulates, but it loses its impact. Fear leaves, and in its place, prudence enters. It is the period when few buy, but it is these few who build the next curve. The market returns to conversing with reality. Income, rent, and cost of capital align once again. And what was noise becomes a signal. Trust is rebuilt, slowly, from scratch. This cycle isn't theory, it's living history. Vegas lived it, Phoenix repeated it, San Diego confirmed it. 3 cities, 3 geographies, one same destiny. In all of them, the plot was the same. Enthusiasm, greed, denial, liquidation, wisdom. And now, as the winds change over Florida, the question echoes again. Have we learned anything from the past? Or are we about to relive the same script once more? The numbers are already whispering the answer. Sales slowing, costs rising, inventories reorganizing. It's not a collapse. It's a mirror. And, as in any mirror, only those who have the courage to look calmly can see the danger. The cycle isn't the villain. It's the teacher. It shows that the market doesn't punish those who make mistakes, but those who ignore the signs. Vegas fell and was reborn. Phoenix bled, but returned. San Diego, slower, rebuilt itself on a solid foundation. And Florida? Perhaps it is in the middle of the journey, neither at the peak nor in the valley, but in the crossing. The truth is that every collapse is a correction disguised as a tragedy, and every valley is the beginning of the next growth cycle. Because in the end, the market is like the sea. It pulls back only to gain strength before the next wave. And whoever understands the rhythm, who isn't frightened by the sound of the receding tide, is the one who survives to surf the next new beginning. Vegas was the showcase of optimism in the 2000s. Where once there was only desert, entire neighborhoods were born. Buying pre-construction, flipping before closing, and repeating the cycle had become a habit, a game of mirrors where everyone seemed to win. The shine was intense. Prices outran income, flips happened without friction, cap rates compressed, and the general feeling was that the city had discovered a machine for endless value generation. Stories of, "I sold in days," replaced questions about risk. Construction multiplied. Schedules were extended. New floors sprouted on the horizon. The sound of concrete mixers was the soundtrack to a collective dream. But every peak is also the beginning of the decline. When affordability began to give way, and the total cost of ownership escalated with interest, insurance, and taxes, behavior didn't change immediately. Production continued. Inventory swelled. For sale signs multiplied to the point where the desert wind seemed to carry them from corner to corner. Months of supply rose, and the days on market no longer fit on one hand. The sales pipeline cooled, and the language of concessions returned. Credits, repairs, bonuses. Each property took a little longer to move, and each seller took a little longer to accept the new reality. The fall was selective, but surgical. It first hit the replicable products on the city's edges, where supply was abundant and differentiation was scarce. By this point, liquidity was already conditional, and without liquidity, pricing becomes a confession. Delinquency tables began to swell. Foreclosures became routine. Auctions took over the weekends. The inevitable liquidation arrived like an impersonal auditor. It scraped away the excess, brought down the top, and returned to the market a price supported by reality. The shine of the peak gave way to the method of the valley. Vegas learned, in concrete and in pain, that speed is not sustainability. Phoenix told the same story, but on a larger scale. The horizontal expansion created a map of cookie-cutter neighborhoods, where each block was a copy of the previous one. During the peak, there seemed to be a guarantee of infinite absorption. There would always be another buyer, another loan, another lot ready to be sold. The phase of accelerated appreciation was clear. Prices outran income, yields compressed, and optimism became self-propelling. The stamina seemed inexhaustible until it wasn't. When affordability deteriorated, the change was mathematical. The payments, insurance, and fixed costs began to not fit in the budget. But production continued. Inventory climbed in steps, signs piled up, and the market began operating with months of stock that only make sense in a buyer's market. Time on market lengthened. Negotiation became the standard language. Discounts, once an exception, became the norm, and the price drop followed the logic of substitution. The more replicable the product, the faster and deeper the correction. In neighborhoods of identical floor plans, the comparables reflected the collapse itself. The financial stress didn't stay on paper. Repossessions, REOs, explicit discounts, all this became part of the market's routine. The balance sheets of construction companies began to incorporate the new reality. Liquidation, then, did the job that the peak's narrative avoided. Clear out, discount, stabilize. Phoenix learned a hard lesson. Perfect substitution also means perfect excess. And the clearing price doesn't negotiate belief, only risk. San Diego is another geography, and therefore a different kind of cycle. With its physical supply constraints, high recurring costs, and the technical complexity of coastal developments, the movement there was slower, but just as inevitable. The pre-2006 appreciation pushed prices beyond income, but what dictated the next step wasn't the market, it was gravity. The total cost began to weigh heavily, with high interest, HOA fees, and insurance, added to mandatory reforms that couldn't be postponed. Affordability slipped, and just a moderate inventory was enough to halt absorption. Sales cooled methodically. Time on market stretched. The dialogue changed its tone, from enthusiasm to caution. The discounts, instead of being dramatic, were surgical. Repricing began in the most sensitive segments: condos with high permanent expenses, buildings requiring technical maintenance, properties dependent on elastic credit. Financial stress existed, but without headlines. It appeared in reports, not in panic. The liquidation, when it came, was silent, like the work of a meticulous accountant. And the bottom, in San Diego, wasn't a point. It was a time frame, a plateau where prices stopped competing with desires and returned to answering to the math. San Diego didn't break. It adjusted. And when everything stabilized, what was left was a slower, but more lucid, market. The Florida crossing Vegas, Phoenix, and San Diego arrived at the same place via different paths. Where substitution was cheap and plentiful, supply weighed heavily. Where recurring costs were high and geography restricted, gravity did the work. But the sequence was identical. Appreciation, loss of affordability, inventory swelling, cooling sales, selective drops, financial stress, and liquidation. In markets of easy substitution, the fall was fast and deep. In those with high permanent costs, it was selective and prolonged. In both, the valley collected what the peak promised without backing. And it is through this lens that everyone now looks at Florida. The question is recurrent. In meetings, cafes, boardrooms, and agent phone calls. In 2025, what stage of this script is Florida in? The signs this time are more subtle. The market has slowed down. What sold in the first week now takes a month. What moved in 30 days now needs adjustments, concessions, and sometimes patience. In several regions, the total number of homes for sale has grown compared to last year, even after a slight retreat from the spring peak. Data platforms pointed to something new. After 110 continuous weeks of increases, The inventory of single-family homes retreated about 4% from the seasonal peak, not due to an explosion in sales, but due to listings being withdrawn. A classic mid-cycle sign. The seller who doesn't need to sell decides to wait. The total cost has also changed the equation. The mortgage payment is only part of the story. Higher insurance, rising condo fees, and recertifications in older buildings have compressed affordability. The impact is uneven. Condos with high expenses are already falling faster. Single-family homes outside of expensive insurance zones are still floating gently. That's why today, two Floridas coexist on the same map. One repricing in a hurry, the other adjusting slowly. The average time on the market has increased. Offers are asking for closing credits and price revisions. Concessions are back, and the market has begun to speak a new language, that of prudence. The numbers confirm the scenario. In September, there was an increase in closed sales for single-family homes, plus 13.6%, and a modest turnaround in condos, plus 8%, while median prices stabilized in the $400,000 range. Houses maintained a variation close to 0%, while condos retreated between 4% and 6%. It's the perfect snapshot of a cycle in stages 3 to 5. High inventory, slow sales, selective discounts. Behind the scenes, alternative thermometers tell the same story. Stable average prices, a slight correction after the 2020-2022 excess. Nothing resembles 2008. Everything resembles a transition. In one direct sentence, Florida is in the middle of the journey. It's not a widespread collapse. It's a selective repricing. For the owner, the game now is one of endurance. Buy time, reduce costs, free up cash. Get new insurance quotes, seek mitigation, participate in HOA meetings, review contracts, prioritize projects that reduce premiums and energy. Save reserves for 6 to 12 months of total costs, and, if possible, generate ancillary income. Whoever sells based on headlines crystallizes a loss. Whoever sells based on strategy chooses the price that closes. For the patient investor, the opportunities lie in the asymmetries. Houses with manageable insurance, post-shock condos that are already recertified, regions anchored in real employment, health, education, logistics. The secret is simple: a real cap rate above the cost of capital, a double-digit safety margin, and no dependence on an appreciation miracle. The cycle has not ended, but whoever understands the rhythm already knows what comes next. Liquidation is not the end. It's the adjustment that makes way for the restart. Vegas fell and was reborn. Phoenix got lost and reinvented itself. San Diego learned in silence. And now, Florida is crossing through. Here at Keynomics, we don't run from the waves. We learn to read the movement. If you want to understand the cycle before it ends, subscribe, activate notifications, and walk with us. Because in the market, as in life, those who listen to the rhythm cross through it better.